we could see if there's not a lot of geopolitical shock that the markets don't like, then I think we could see spot gold and silver stay within a range, giving the technicals a chance to catch up before it goes on to its next leg. Yeah. If, however, we do see that might tested, then I think we could easily see silver, maybe $150 or even $200 on spot market. And I think we could easily see gold maybe 6,000 on the spot market.
It would wipe the shelves clean, and it would probably affect a lot more than what it did 3 years ago, because the supply and demand equation now is just so razor thin.
Gold and silver markets are showing unprecedented dynamics as investors grapple with the erosion of purchasing power and systemic financial risks. Over the past year, inflation and government policies have quietly chipped away at the real value of money, leaving many unaware of how quickly wealth is being eroded. The only thing holding the system together, experts say, is public confidence, and once that begins to waver, the consequences could be dramatic. Lynette Zang, a leading market analyst, emphasizes that this is not random, but a deliberate result of a financial system structured to benefit insiders, while the general public bears the cost. According to Zang, understanding these mechanisms is critical for anyone seeking to preserve wealth, as traditional indicators often mask the true pace at which purchasing power is disappearing. On the global stage, economic control is increasingly intertwined with geopolitical force rather than conventional contracts. Recent actions, including the U.S. seizing Venezuelan oil and intercepting foreign shipments, underscore a new precedent. Ownership and control can be enforced through power rather than law. Zang warns that this signals a shift toward a world order where citizens have less protection, and investors must account for political risk in ways they haven't before. Historical examples, such as past gold confiscations in the U.S., combined with the opaque handling of national reserves like Italy's central bank gold, demonstrate how governments can subtly assert control over resources. For Zang, these developments highlight the urgent need for individuals to secure assets that remain outside the reach of political maneuvering. In the precious metals sector, these pressures are already influencing market behavior, with physical demand increasingly driving price discovery. Zang predicts that if geopolitical tensions intensify, silver could surge to $150 to $200 per ounce on the spot market, while gold could reach $6,000 per ounce, figures still below their fundamental value. She stresses the critical importance of holding physical assets, pointing out that tangible gold and silver remain one of the most reliable ways to protect wealth amid currency devaluation, inflation, and potential market manipulations. Investors are encouraged to consider these metals not just as commodities, but as essential insurance against financial and geopolitical instability, a safeguard that cannot be created or diluted by central banks or paper contracts. Now we present the clips from Lynette Zang's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
We don't see what's happening beneath the surface, and that's really where you're going to get the most truth. And it really is like a pump and dump, especially with the private equity. Now we want to put them into 401ks, and that's just piling on more risk to the unsophisticated. But why are we doing that? If private equity, all the money gets made before the public gets involved, right? It's keeping stocks private for a really long time and then dumping them onto the market in the billions of dollars in value because private equity or private investors have bid that up. But does that really mean that's the true value of that? And even if it is, if all you can convert it back into are dollars, then doesn't the value of the dollar matter more than anything else? That sure seems to be what we're entering. But, when we're transitioning into a new financial system, doesn't it also make sense that we could be transitioning into a new world order, something that we've been talking about for quite some time? But the way that, or the precedents look, I'm not staying political. I'm not going to tell you whether I agree or I disagree. The markets certainly think that it was, wonderful. And if you listen to a lot of people, they think that it was wonderful. But I can look at it and see the precedents that it opened up. And it isn't just the US that can do that now. What happens if China decides to indict President Trump? Does that, in their courts, does that give them the right to go in and take him out of the country, right? Or Russia. So that's what really, I think it's just a ratcheting up of World War III and wars. We've breaking out all over the world. And even President Trump saying that he's not opposed to taking Greenland by might. So this sets a very dangerous precedence. Who knows when we're going to feel the results of it, but I think that for many years to come, and I think that this is part of the shift into a completely new regime, even larger than the financial system, even larger than that. Global central banks that have really been scooping up all the gold that they could since 2005. This is not a new phenomenon, but interestingly enough, if you think about the date and you look at the charts, it was 2005 when that shifted, a full 3 years before the great financial crisis became apparent to the public. Right. Yeah. So that's what I'm trying to tell you. These things take time. By the time the public sees it, it's been in the works for a long time. And I applaud this one because I'm tired of these contracts controlling, and people don't realize this either, but these trading contracts for traders to make money, dictating the price of food and the price of energy and the price of gold and the price of silver and the price of everything. The price of everything is dictated by traders that are just looking to pick up a little bit of money. They don't care about the economy. I think that's one reason why you're seeing the difference between what's happening in Main Street and what's happening in Wall Street. And that's another indication that there's something that is very, very askew. Because of the actions in Venezuela and basically the U.S. taking over, really, I mean, I can't say that really the global oil supply, and also the smart contracts coming out, because I do think that both of those were about elongating the power that the dollar still holds. I don't think that what just happened is going to go unnoticed. So I would think that at some point this year, that might over law could be tested again, and maybe by a foreign power that we don't really want to test it, like China or Russia or China. So that's kind of scary. But I also think that in the metals market, we are going to see, first of all, both gold and silver are technically overbought, not overvalued, just overbought. So I think that we could see, if there's not a lot of geopolitical shock that the markets don't like, then I think we could see spot gold and silver stay within a range, giving the technicals a chance to catch up before it goes on to its next leg. If, however, we do see that might tested, then I think we could easily see silver, maybe $150 or even $200 on spot market. And I think we could easily see gold maybe 6,000 on the spot market. Even those numbers are still far below their true fundamental values. So
recent developments in the gold and silver markets are highlighting a widening gap between paper-driven narratives and the realities of physical supply. As AI-generated content and recycled commentary increasingly cloud market signals, seasoned observers are urging investors to focus on what is actually happening beneath the surface. Volatility in precious metals has intensified, not as a random event, but as a response to deeper structural pressures tied to global debt, fragile funding systems, and shifting confidence in traditional financial instruments. According to Bill Holter, these price swings are a symptom of stress building within the system rather than a sign of instability in the metals themselves. Holter points out that gold and silver are reacting to a loss of trust in paper markets as physical demand accelerates at the institutional and sovereign level. Gold is increasingly being treated as a balance sheet asset rather than a trade, while silver is showing signs of tightening availability as industrial usage and investment demand collide with constrained supply. He emphasizes that paper mechanisms are struggling to manage this transition, leading to sharper moves and frequent dislocations. From a broader perspective, the market appears to be entering a phase where physical ownership and delivery matter far more than derivatives or promises, setting the stage for continued turbulence and a potential repricing of both metals as confidence in financial intermediaries continues to erode.
The volatility has definitely picked up. Actually, the volatility in bond markets is almost non-existent, which is kind of shocking. The only bond market worldwide that is actually declining and declining hard is the Japanese bond market. The yields in Japan have gone, we're almost at 350 now on a 30-year bond. That's up from 0.75. And the reason I bring this up is because, yeah, it's not just exchanges, it's sovereign treasuries, sovereign central banks that are stepping up, primarily buying gold, although I believe India and China are both buying silver. But it just makes sense what they're doing is onboarding gold onto their balance sheet, because we live in a system that is going into bankruptcy, going into insolvency. And these central banks are worried if they hold too many dollars and no gold, and there's a dollar problem, a credit problem in the United States, and the dollar gets smoked as far as purchasing power, then where does that central bank stand if they don't have gold? So what they're doing is they're unloading gold that will rise in value to fill up the holes, if you will, that are created by a dollar devaluation. Yeah, they're buying gold and having it delivered to them, to their country. In the past, what have we seen? We saw 4 years ago, 5 years ago, $1 billion, which is now well more than $2 billion, of Venezuelan gold was basically sequestered by the LBMA, by London. We saw in October 2023, we saw the Biden administration sequester over $300 billion of Russian U.S. treasuries that they held. The only problem is they didn't really hold them. They got shut off from that. So countries are seeing that they're being attacked and shut off in the SWIFT system. So their way around that is to buy the universal money, and I say money, not currency, gold, that cannot default. It can't bankrupt. If it's in your possession or in a country's possession, they can't be shut off from the world trade because they have capital. Whereas if they are just in a SWIFT system and have no gold whatsoever, they can be shut off. And I caution listeners that this is exactly what's going to happen when we go to central bank digital currency. If you say the things you and I talk about, Dunnigan, and we're in a central bank digital currency system, you're going to be shut up. There's no beans and tortillas for you tonight. Well, I think I would just say it's the smell of blood in the water. People are understanding that supply is tight. People are understanding that demand has definitely overwhelmed supply. So they know the supply-demand situation, and people are when you tell a human being that they can't have something, they want it even more. And that's what's happening, is that there's fear out there that there's not going to be product. And I've also said this for many years. When this thing goes down, you're either in precious metals or you're out. If you're out, you're not going to be afforded the chance to stack and put a position together, because none will be available for sale for whatever amount of fiat you want to pay. Dealers are worried, am I going to get my shipment? Am I going to get the whole shipment, only part of the shipment? It's pretty hard to take future orders against a shipment that you don't know is going to be a full shipment or even if it's going to arrive. So, dealers are pulling back, raising the premiums and thinking, okay, if we don't get any more, at least we're going to get paid on what we're selling now. Well, done again up until a week and a half ago, if you noticed, all the dealers were really fighting on price. It was all the dealers, especially in silver, all the dealers were marking down the premiums to the point where, they were very, very skinny trades for the dealers. That has turned 180 degrees. And it's not surprising because, dealers are not machines. Dealers are people too. Let me just mention one other thing. A lot of people know that I did a very large trade a little over 3 years ago. It was a $50 million trade that cleaned up every Silver Eagle, every bag of junk, and pretty much every single pre-1933 gold, Liberty, or St. Gaudens. And that was just with $50 million. That was 3.5 years ago. That was before the SVB bank problems, before that cleared the shelves. What I'm getting at is if a $50 million order came in today, and that is a paltry amount of money. Understand that in today's world, $50 million is nothing. But if you had a $50 million trade and said, I want to buy every U.S. Silver coin and every U.S. pre-1933 coin, gold coin, I don't think that order could be done today. I think it would wipe the shelves clean, and it would probably affect a lot more than what it did 3 years ago, because the supply and demand equation now is just so razor thin.
Global financial markets are entering a period of heightened uncertainty as systemic pressures continue to mount. Investors are increasingly attentive to the declining stability of fiat currencies, rising government interventions, and growing geopolitical tensions that are reshaping traditional trade and ownership frameworks. Physical commodities, particularly gold and silver, are emerging as critical stores of value, reflecting both their intrinsic worth and their role as a hedge against inflation and financial instability. Market participants are observing widening spreads, delivery delays, and unusual exchange activity, signaling a shift from paper-based trading toward tangible asset allocation. Looking ahead, analysts suggest that metals markets could experience dramatic movements if global events test the durability of monetary systems. Silver, for instance, may surge significantly, potentially reaching triple-digit spot prices, while gold could advance to levels far exceeding recent benchmarks. Such trends underscore the importance of maintaining holdings in physical assets, as reliance on digital or paper claims alone may not provide sufficient protection in times of systemic stress. The broader implication is a market increasingly governed by supply constraints and geopolitical influence, rather than conventional price signals. Will physical commodities continue to outperform traditional instruments, or will new regulatory and technological mechanisms alter their relative value? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.